The US-Iran ceasefire wiped 16% of oil in a single trading day. Not a war or a sanctions package, a peace deal. And if you had oil positions open when it happened, the question is not whether you felt it, it's whether your trading stop losses survived it. Because for most part-time traders, a 16% move in one day doesn't just hit your stop loss. It blows through it like the stop was never there. And by the time you check your phone after work, the damage is already done. When I looked at my own oil trades after this crash, my account had barely moved. And the reason comes down to one rule that most traders skip because it feels like too much maths. By the end of this video, you'll have a 3-step check that you can run tonight to know whether your stop losses would survive the next crash like this. On the 8th of April, 2026, CNN and CNBC reported that crude oil fell by 16.41% to $94.41 per barrel. That's the biggest single-day oil crash since April 2020 during the pandemic. But most of the coverage focused on the geopolitics and the ceasefire terms, not on what that move actually does to our part-time traders' open positions. Here's what a 16% single-day drop actually looks like on your account. Oil did not drift down slowly over a week where you could react. It collapsed in hours. Crude oil went from trading above $113 to settling at $94.41 by the end of that day, which is roughly 1,900 pips of movement. If you are a part-time trader with a 50 pip stop loss on oil, that move is 38 times the size of your stop loss. Your position was closed in the first few minutes and you never got a chance to manage it. And that's assuming your broker filled you at your stop price. Because in moves this fast, slippage means you probably lost more than you planned for. That's the moment that every part-time trader dreads. You log in after work, expecting a normal session, and the number on your screen does not match what you left behind. You are telling yourself, it's probably a glitch, that the price must have come back by now, but it didn't come back. And this time, it's not a small trading loss. It's the kind of loss that makes you question whether the whole thing is worth it. This is exactly why I believe ATR stops adapt to market violence. Fixed stop losses are just prayers in a firefight. A fixed stop loss does not know what kind of market it is sitting in. So it's the same with whether oil is moving 30 pips a day or 1,900. But the part that makes this crash different from most is what caused it. This was not a slow economic shift. On 7th of April, President Trump announced a 2-week ceasefire with Iran, less than 2 hours before his own deadline to escape military action. Nobody was positioned for peace that day, or at least not the kind of peace that drops prices that fast. And that's what makes this so relevant if you trade part-time. You are probably at work when this happened, so you didn't see the announcement and couldn't have reacted, even if you wanted to. Maybe you are sitting at your desk thinking, I'll check when I get home. It's probably fine. By the time you opened your trading app on your commute home, the crash was already over and your positions had already been hit. And that's actually the point, Trade on News. That's a belief that I've held for years, and this crash is a perfect example of why. Stop trading headlines and start trusting tested chart signals instead of media noise. The traders who reacted to the news that day made decisions based on fear and confusion. But the ones who had a trading system in place did not need to react at all. And I can show you exactly what that looks like, because I had 2 specific oil trades open when this crash happened. Both trades hit their stop losses. A 16% move is going to close your positions. But here's the difference. Each trade lost roughly 1% of my account. Not 5%, not 10%, about 1% per trade, because my stop losses were set using the average true range, which automatically widened the stop loss to match the oil's volatility at the time. And because the stop was wider, my position size was smaller. So the dollar risk stayed controlled even though the pip distance was larger. My total net impact from this 16% oil crash was minus $17 on a $20,000 account. That's 0.085%. A separate currency trade I had opened that week actually gained $403, offsetting most of the oil loss entirely. So while oil was collapsing, my overall account was essentially flat. And it wasn't because I saw the crash coming. It was because the system did not have everything riding on one market. The market moved 16%. My account moved 0.085%. Same crash, different rules. But here's what this crash actually exposed. If one violent move on one asset can blow through your stop losses and damage your account, the oil crash is not really your biggest problem. Your trading risk setup is. There is a free diagnostic quiz that identifies the most common reasons part-time traders keep losing money. It takes about 3 minutes and the link is in the description below. But whether you take the quiz or not, there is one specific thing you can check on your trading account tonight. So here's what I'd actually do tonight if this crash made you nervous. 3 checks and all doable in under 5 minutes. Open your broker platform, pull up the last oil or commodity trade that you placed, and look at how your stop was set. If it was a round number of pips, like 50 or 100, that's a fixed stop. It doesn't adjust to market conditions, and it's exactly the kind of trading stop that gets destroyed in moves like this. Now, pull up the ATR indicator on your daily chart for that same instrument. The ATR tells you the average range that instrument moves in a single day. If your stop loss was smaller than roughly 1.5 times the ATR value, your stop was sitting inside the normal daily noise. The market did not even need a crash to take you out. And here's the step most people skip. If you widen your stop to match the ATR, you have to reduce your position size to keep your dollar risk at 1% of your account. That's the trade-off. A wider stop with a smaller position means the same dollar risk, but far more breathing room. On a $10,000 account, risking 1%, that's $100 at risk, whether your stop loss is 50 pips or 200 pips. The only thing that changes is the lot size. And if you skip this step, you've just quadrupled your trading risk without realizing it. My oil trades survived a 16% crash because the ATR set a wide stop and the position size calculation kept the cost at 1% if that stop was hit. That's the difference between the trader who checks the news and panics and the trader who checks their system and finds it already handled the situation. Be the second one. You saw what 0.085% looks like next to a 16% crash. But checking your stop type tonight is one step, and replacing news-based trading decisions with a tested system that handles the next crash without you, that's the step most traders never take. This video will show you exactly how that system works and how it fits into 30 minutes a day. Without it, the next crash is a coin flip. So see you in that video.